After 5 years, the economy is finally climbing out of a housing bust and a debt bubble. But while Americans have been paying down credit cards, mortgages, and car loans, there's one form of debt they've been taking on in droves: student loan debt. Student loans have risen so high, it's prompting concerns that it's become too easy to borrow too much for education. Khalila Parame graduated college over 6 years ago and now faces over $100,000 in student loans.
It will take me 20 to 30 years to pay them back. And right now I haven't even been able to pay them because they're just so high. And I've actually spoken to the people that have called me about payments and trying to arrange payment situations, and it's still ridiculously expensive. It's almost more than what my rent would be.
Khalila attended Hampton University to pursue a degree in business management, but during her sophomore year, she switched majors to become more marketable following graduation. Khalila is one of many Americans staring at student loans for years to come. Student loans are quickly piling towards the $1 trillion mark. To be exact, since 2007, student loan debt has ballooned 56% to $956 billion as of September 30th, 2012. That, according to recent data from the Federal Reserve Bank of New York. Over that time, total household debt, which includes mortgages, auto loans, and credit cards, has fallen 18% to $11.3 trillion. And delinquencies are picking up. Payments on 11% of student loan balances were 90 days or more behind as of the end of September. That's up from 8.9% at the end of June. What's worse, the Fed's figures understate delinquencies. A lot of borrowers aren't required to make payments yet because they're still in school or have been given more time to repay their loans. The Department of Education allows borrowers to postpone payments during times of hardship, say if you lose your job. Student lending grew in popularity in the 2000s along with other types of consumer borrowing. Most student loans were made by private lenders and backed by the federal government. But in a money-saving effort in 2010, President Obama pushed Congress to cut out the middleman and make the federal government originate student loans directly instead of simply guaranteeing them. The result? Private lenders were cut out of the equation, and the federal government now makes 93% of all student loans. Intentions were good: equip young Americans with a good education so they can build prosperous lives for themselves. But unintended consequences have surfaced. In trying to make college education affordable for everyone, the government forewent minimum credit scores because it would block many Americans from going to college. Sound familiar? We've seen this movie before with housing. The government eased standards on loans originated and backed by Fannie Mae and Freddie Mac to make home ownership a reality for more Americans. Those actions led in part to the housing bust by extending mortgages to subprime borrowers who couldn't afford them. Just as the government eased requirements with housing, now it's eased requirements on student loans to make a college education affordable to everyone. But Jeffrey Cleveland, senior economist at Payden & Regal, an investment firm based in Southern California, says this situation is different.
It has a lot of the hallmarks of the subprime scandal, the subprime debacle. So you have rapid credit growth, you have the lowered lending standards, but there's one very, very important, I think, missing ingredient that will prevent it from becoming what subprime became. And that was mortgage debt was an ingredient in the financial system. So it was held by banks to meet capital requirements, and more importantly, was held by banks and non-banks to borrow in the overnight markets. So an institution could hold certain bonds and they could use those as collateral to borrow overnight. And that's what really caused the subprime infection to go from being an isolated small part of the mortgage market to rippling through the entire systemic financial system, causing a real systemic crisis. I don't see that same setup for student loans.
The federal government's student loan programs are profitable as a whole, despite the high delinquency and default rates.
There may not be a crisis in store, but there are consequences for those who don't take financial care.
While there isn't a global, universal set of bubbles, there are individual personal bubbles, students who borrow too much for their education. And when someone defaults on their loans, it ruins their credit future. It ruins their financial future.
A study done by Rutgers University in May showed 40% of college graduates from 2006 through 2011 postponed a major purchase because of their debt burdens.
It's worthwhile to impose some reasonable limits on the amount students can borrow for their education, if for no other reason than to protect the students from themselves.
Right now, there's no limit on the amount parents can borrow on behalf of their children for college. The government examines parents' past behavior in repaying loans, but doesn't look at their ability to repay the student loans. Loans to students are capped at $57,500 for undergraduates, but no credit standards are imposed. Just because the government is willing to lend you large sums of money for education doesn't mean you should take it. For students considering borrowing for college or graduate school, here are some tips to keep in mind. Take steps to minimize your student loan debt. Save as much as possible for college to minimize the amount of debt you have to take on. Search for scholarships on free websites like fastweb.com. Base the amount you borrow on your projected starting salary after you graduate.
If your debt is less than your income, you'll be able to repay the student loans in 10 years or less.
And tap federal loans before private loans because federal loans are cheaper, more available, and have better repayment terms. You can get temporary suspension of the obligation to repay the debt if you hit a rough spot. Say, if you lose your job and expect to get a new job in a few months, or you're on medical leave. Federal loans also have death and disability discharges as well as loan forgiveness, which most private student loans do not. If you've completed college or graduate school and are staring at student loans as far as the eye can see, here are some tips to minimize your debt load. Take advantage of the student loan interest deduction. You can deduct up to $2,500 of student loan interest from your taxes on both federal and private student loans each year. Also, if you have multiple student loans at different interest rates, use any money you have left over after you've made monthly payments on all loans to pay down loans with the highest interest rate first. From the Department of Education, I'm Jennifer Schonberger.